Friday, October 10, 2025. It began like any other day in a bull market, brimming with digital optimism and the quiet hum of servers. Enthusiasts spoke with conviction about October, a historically bullish month in crypto. Bitcoin flirted with unprecedented highs, a beacon of prosperity for the entire digital asset space. But as afternoon shadows stretched across financial capitals, a brutal shift occurred. Vibrant green candles suddenly flipped to a violent cascading red. In hours, markets fell hard, as if plunging off a cliff no one saw. Bitcoin plummeted by roughly $20,000 in a single day, erasing years of gains. Pain spread with terrifying speed. Altcoins fell even faster, portfolios bled red, and panic flooded social feeds. A perfect storm, human psychology, a policy shock, a fragile macro backdrop, and crypto's volatile mechanics converged into a catastrophic sell-off. To understand the crash, look into market psychology, the euphoria before and the fear after. In the weeks prior, unbridled greed took hold as prices shattered records, confidence bred complacency, traders, large and small, took on more risk. Leverage lets small capital control big positions, and magnifies both gains and losses. A small dip can wipe out the initial deposit via margin calls and liquidations. In a day, the pendulum swung from celebration to panic. Herd behavior took over. Selling begot more selling in a self-reinforcing spiral, especially among newer investors. The sentiment index plunged from greed to fear within 24 hours, one of the fastest reversals on record. The cheering crowd of the uptrend became a stampede for the exits. In crypto, sentiment is king, and it can turn on a dime. While psychology primed the fall, a sudden policy shock pushed things over the edge. On the afternoon of October 10, the US president announced a 100% tariff on all Chinese imports. The measures were set to take effect November 1st. Global indices nosedived as traders priced in a trade war. Markets weighed slower growth against resurgent inflation and higher costs. Appetite for risk evaporated. Stocks, emerging currencies, and especially crypto sold off. Investors hoping for rate cuts saw those hopes doused by the inflationary shock. A renewed inflation threat implied policy staying higher for longer, or even tightening. For leveraged crypto traders, the headline was a spark in a dry forest. Within minutes, sell orders flooded exchanges. The shock struck a market already on precarious footing. Throughout 2025, central banks kept rates elevated to tame inflation. Respectable low-risk yields made volatile assets less attractive. The zero-rate China era was over, replaced by sober capital allocation. A 100% tariff implied new inflation pressure and slower growth, stagflation risk. Imminent rate cuts looked unlikely as markets braced for hawkish tone. With fear high and rates elevated, there was no cushion to absorb bad news. The realization hit. Higher for longer was a gut punch to speculative crypto. Algorithms and traders react instantly to policy language. Hawkish signals can topple risk. Macro primed the crash. The headline lit the fuse. The market's internal plumbing, leverage and liquidations turned a downturn into a crash. Price drop, margin calls, liquidations. Crypto derivatives allow extreme leverage, sometimes up to 100 times. When margin isn't added, exchanges auto-liquidate at market. Mechanical, not emotional. Each liquidation adds sell pressure, triggering the next wave. A long squeeze. Post-crash tallies showed roughly $19 billion liquidated and over 1.6 million accounts wiped out. The market ate itself from the inside out, fueled by the very leverage that powered its rise. Compounding the cascade was a sudden lack of liquidity, the ease of trading without moving price. It hit on a Friday afternoon. Order books were unusually thin. Thin liquidity created a vacuum as forced sells slammed into few bids, like throwing a rock into a shallow puddle versus a deep lake. The splash is bigger in shallow water. Bitcoin wicked to absurd intraday lows on some venues before buyers stepped in. Altcoins, less liquid and more volatile, suffered 20 to 30% drops or more within hours. Meme coins fared worse. Some collapsed by half. Data platforms buckled, exchanges lagged, apps froze, users couldn't log in or trade. When systems fail in crisis, fragile trust erodes fast, and fear deepens. By evening, the market was a sea of wreckage, technical stress amplifying financial pain. In the days that followed, liquidations exhausted and prices found a temporary bottom. Bargain hunters and long-term believers stepped in, cautiously. Roughly $280 billion vanished from total crypto market capitalization. For many, losses were personal and painful, life-altering for some newcomers. Two narratives emerged: necessary reset versus broken trust. Optimists called it a healthy purge of excess leverage, transferring coins from weak to strong hands. Skeptics saw lasting damage to public confidence and headlines branding crypto as a casino. Recovery hinges on trade de-escalation, central bank signals, and stronger industry infrastructure. Amid the debris, a question endures: can a phoenix rise from these ashes? For anyone watching, the crash delivered 4 powerful lessons. First, respect risk. Higher potential returns come with higher potential losses. Invest only what you can afford to lose without harming your well-being. Second, leverage is a double-edged sword. Avoid or keep it very low. Buying spot with your own capital removes forced liquidation risk. Third, diversify across crypto and beyond crypto to smooth volatility. All in on one token is unnecessary risk. Fourth, predefine your plan, goals, take profits, and stop-loss rules. In panic, emotions overwhelm logic. Your plan is your anchor. A thoughtful framework helps you avoid the worst decisions at the worst moments. In conclusion, the great crypto crash of October 10, 2025 was not random. It was a perfect storm of 4 converging forces. First, market psychology, excessive greed and crowded leverage. Second, a sudden tariff announcement as the trigger. Third, high interest rates already suppressing risk appetite. Finally, liquidation cascades and thin liquidity made it catastrophic. The path forward hinges on external factors, trade tensions, and central bank policy. Internally, exchanges and data providers must harden infrastructure. History shows rebounds, but past performance is no guarantee. Volatility is a feature, not a bug. Peril and potential coexist. Will crypto rise again? Only time will tell. The world is watching. If you found this clear and helpful, please like and subscribe to Express Econ Geo Finance Insights, and share your thoughts in the comments. What aspect of the crash was most significant?